Tesla cuts prices again. The Wall Street Journal reporting on April 7th that Tesla is cutting prices again. Tesla will cut prices on its Model S and Model X vehicles by $5,000 each to 84,990 and 94,990 for the base models respectively. In this video, I'll talk about what that could mean for Tesla stock investors. So let's get right into it. So this is not the first Tesla price cuts, as the article headline alludes to. Tesla cut prices again. Since November of 2022, Tesla has been cutting prices both in China and in the US and Europe. And so management was asked about a potential customer demand problem late last year, to which management responded telling investors that no, we don't have a customer demand problem. We've still got a lot of orders, but the evidence continues to show that Tesla does indeed have a customer demand problem. Otherwise, it wouldn't continue cutting prices. If it was able to sell the cars at existing prices, price cuts would not be necessary. And so I've mentioned in my videos before that when a company cuts prices, it's not acting alone in an environment, in a business environment with itself and its customers, right? So Tesla, you might feel like, okay, Tesla cuts prices. That means its customers are going to be more interested in buying its cars, and so customer demand is going to increase. That's a reasonable assumption to make. However, it doesn't necessarily turn out to be the case. What often happens is when one company initiates a price cut, rivals in the industry observe that one of their competitors is lowering prices, and they don't allow that competitor to cut prices without consequences. They typically react because price cuts are a move to try and increase sales. When you're trying to increase sales, your competitors are not happy about that, right? Because you're trying to take market share and your competitors feel threatened by that move. So competitors respond to your price cuts. Either they cut prices, or they increase advertising, or they announce increases in supplies. In some way, they react to your price cuts to demonstrate to you that they're not happy with your price cuts, and they're not just going to let you try to take more market share. And so the article actually alludes to this, that rival automakers have also cut prices, including Ford and many others, right? So in response to Tesla cutting prices, rivals have also cut prices. So this has just caused a significant increase in industry-wide competition, which is expected to bring down profit margins industry-wide. Now, Tesla is in the lead in terms of gross profit margins in the industry overall. However, that doesn't mean that those profit margins are not going to come down. In fact, Tesla's management as much as admitted to the fact that its profit margins, its gross profit margins, will likely come down into the teens in 2023. And if these price cuts are any indication, that is more likely to be the case now with another round of price cuts. A few days ago, Tesla announced delivery figures for its first quarter, and I made a video about this, and I highlighted that deliveries of the Model S and Model X were down year over year. So deliveries of the Model S and Model X were 10,695 in the first quarter. That's compared to 14,724 in the same time the year before. So this is a growth company that's saying that it's going to grow at a 50% compound annual growth rate. Meanwhile, it's got one of its segments, the luxury car segment, decreasing year over year. Now, it is important to consider that it is a small fraction of its overall deliveries, right? 10,000 compared to 400,000 of Model 3 and Model Y. But the Model S and Model Y are, Model S and Model X are priced nearly double that of the 3 and Y. And you can reasonably assume that the profit margins on the higher priced models are higher than the profit margins on the lower priced models. So decreasing unit sales of the higher priced models are more hurtful than decreasing sales of the lower priced models. And that's exactly what Tesla is experiencing right now. And the price cuts here signify that there is more trouble that Tesla is seeing in its internal data that is not yet reflected in publicly available information to show why Tesla is cutting prices again. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So what this could mean for investors, let me wrap it all up and put a neat little bow on it here. It means that gross profit margins for Tesla are likely to decline even further than was expected. Even further than was expected. So, if in 2023 we were expecting gross profit margins to be somewhere, let's say, in the range of 18 to 22%, we can now lower that estimation to, let's say, between 18 and 20% in terms of gross profit margins. It also means that investors should prepare for competitors to announce more price cuts as well. So Tesla, this just came out, so you can look forward to competitors announcing price cuts of their own, right? So just because competitors are losing money doesn't mean they cannot announce price cuts. And they have, and they will, because many of their competitors have deep, deep pockets. So they can afford to lose money for a very long period of time. And so they say, hey, Tesla, you want a price war? Let's have a price war. They're not going to shy away from having a price war just because they're not as profitable as Tesla. And recent moves have indicated they are willing to indeed enter into a price war. So lower profit margins for Tesla to be expected, lower profit margins for the industry also to be expected. Now, whether or not this is going to spur consumer demand remains to be seen. That part of it remains to be seen. If everybody starts lowering prices, is that going to cause an industry-wide increase in consumer demand? Maybe, maybe. That's another thing to look out for. Maybe this causes more consumers to be interested in buying electric vehicles because everybody is going to start lowering. I shouldn't say everybody, but competitors, several rivals are starting to lower prices, and so that might spur consumer demand. Okay, so lower gross profit margins, almost certainly to be the case for Tesla and the industry in 2023. The following increase in consumer demand is questionable. That may or may not happen. All right. So the lower margins are almost certain. The rise in consumer demand less certain. So that's the takeaway from these price cuts from Tesla, is that lower profit margins and perhaps a stoking of increased competition, and followed by an increase in consumer demand. All right, so that's all I've got for this video. Thank you so much for watching. I hope I'll see you again next time.